From the Nasdaq market site in Times Square, I'm Brad Smith. Our next guest for today is co-founder and chief investment officer of Highland Capital Management, and you can catch his insights regularly featured on CNBC's Squawk Box and Bloomberg and in many other media outlets, including here on a previous episode of our Facebook Live series entitled Behind the Bell. So here today to discuss whether investors have missed the opportunity to get into the loans market, we're joined by the man, the legend, Mark Okada. Mark, great to have you back here at Nasdaq.
It's great to be here, Brad. Thanks.
Absolutely. Now, your firm primarily focuses on credit. What are some of the areas of credit that you think investors should be paying a little bit more attention to right now?
Well, the credit market is always a mixture of two kinds of risk. We have economic risk, what's the economy doing, what are companies doing in that economy, and the flip side is what's happening with interest rates, because credits are fixed income market, and so you have both kinds of risk. And so as investors think about the credit markets today, they got to think about both. But one, they can feel pretty good about. The economic numbers have been very good, and the corporate economy is very healthy. But the other thing that's top of mind for a lot of credit investors is the interest rate risk. And so that's an area I think that we spend a lot of time thinking about, and certainly has become top of mind for most investors.
So as we have this impending interest rate rise on the horizon as well, how does that play into all of their sentiment?
Absolutely. So if you just turn back the clock and look a little bit of what's happened between markets that are floating rate, that really don't have interest rate risk and maybe can benefit from rising rates, and fixed rate markets. So we think of like the US Barclays Ag, which is a big corporate debt market that has everything from treasuries to high yield bonds, but it's all fixed rate. And we look at the relative performance of that versus something like floating rate loans since the election. So we're down about 2% in that Barclays Ag. We're up almost 3% in the loan market. If you annualize those two numbers, you're getting a 15% pickup just to rotate out of interest rate risk and into a floating rate dynamic. So it's really an important thing to focus on right now because, let's see, the Fed has already said very clearly that they're going to go in March, which that's a change from last week.
Right.
And so they're going to go in March. And could we get 3 rate hikes this year? Absolutely. So I think those kind of rate moves means that fixed rate debt will have much more interest rate risk in it, and so floating rate debt will take advantage of that.
So, but with bank loans trading at around par right now, is it still a good time to allocate capital to loans?
So it depends on how you're doing this, right, and what part of your portfolio. I think that loans are, from the dynamics of the two risks I just talked about, a great place to allocate. And so there are certainly a lot of opportunities, but as to your point, right, the market's already moved a lot. And it's gone from a place where we could get capital appreciation and interest coupon income to a place where really a lot of it is going to be, how defensive is your manager, how on top of the portfolio they are, and then capturing this rate rise that we're going to get. So I think the beta outcome or the outlook for the asset class this year would be somewhere in the mid-5s, or a little better than that, depending on how many rate hikes we get. And that's, in the fixed income world, those are giant numbers, right?
Wow.
When you have negative number coming out of things that are more interest rate sensitive.
So what are some of the ways then that investors can still access the loan asset class?
So the nice thing about loans is that the market's been around for a while. We started our firm in '93. At that time, there weren't any real institutional players. There are a couple small players in the space. Today, there's a lot. And so there's a fairly large mutual fund, actively managed mutual fund universe. There's also an ETF universe that's come along. And then there's the traditional institutional products that we all know about. But investors really have a choice between beta products, and some of the actively managed mutual funds are actually beta products. They're just disguised as mutual funds. But beta products are traditionally things like an ETF, which is what we listed with you all. But on the flip side, right, you can have actively managed portfolios, such as our Highland Floating Rate Opportunities Fund, where we have a very alpha-driven dynamic where we're very active with the portfolio. And as we see risk popping up in the market, we're either going to be avoiding it, we call that alpha by avoidance, or we may lean into situations and therefore creating very high returns for investors that really represent us taking that floating rate, that interest rate risk off the table, but taking advantage of the fact that this market is developing from an economic standpoint, and there's going to be winners and losers around that. So I think a lot of fixed income investors get worried that the market's already moved so much, and so why should I allocate now? I missed it. But that's not really the dynamic. Now it's a more a function of let's stay invested, but let's pick the right manager, or let's pick the right sort of entry point for what I really want it to be.
Right. So what separates then your loan ETF from other bank loan funds that are out there?
So ETFs are beta products, right? And you need to have two very important dynamics for an ETF to work right.
Okay.
Number one, you have to have low expenses because it's an access product. It's one of the reasons why ETFs have been so popular is because they provide a very low-cost way for investors to get access to a market.
Right.
And that's not going to change per se. So our ETF has the lowest expense ratio in the space.
Wow.
So it's the cheapest way to get exposure to the bank loan market. And the other dynamic that's really critically important with ETFs is liquidity. And you can imagine that when you have a market like bank loans that is less liquid than a corporate bond market or a treasury market or certainly the equity market, then liquidity becomes something that you're hyper-focused on. And so we constructed our ETF around the 100 most liquid loans index.
Oh, wow.
So Market Partners has an algorithm where they look at the entire $1 trillion universe of loans, and they figure out which are the ones that trade the most, which are the ones that are the most quoted, that have the most liquidity.
Sure.
And we based our ETF off that index. So we've got the lowest cost, but also the better mousetrap, because you want that liquidity when you're in ETF. You shouldn't have, you got to have both, but if you have an illiquid ETF, it's kind of that doesn't make any sense.
Right.
So we made sure that we constructed our ETF around the most liquid loans and then had the lowest cost.
So looking more broadly, what role do you see then loans playing in investors' portfolios today and going forward?
Right. So our view has always been that the bank loan asset class, because it is one of these lower correlated, low vol asset classes within fixed income, should be a core allocation. Shouldn't be something where, unlike maybe high yield bonds or emerging markets where you're trading in and out of a market, you should have a core allocation to that within your fixed income allocation, because you've got floating rates, which mean you're not taking interest rate risk, and you're exposed to the U.S. economy. Now, in the times that we are in today, where we've got a lot of interest rate risk and the U.S. economy seems to be picking up and doing well, then I think it's a very good time to be a little bit overweighted with however you're using this in your asset allocation. So it's a good place to rotate out of fixed rate risk or even unsecured high yield bond risk into loans. They're actually trading right on top of each other right now. And a time when you can pick up nice attractive cushion yield where you're not taking this interest rate risk. That being said, right, investors should understand that these markets are dealing with a lot of new things. Right. We have a new president. We have a new Congress. We have, we'll have a new Supreme Court. We'll have a new Fed at some point. Right. And so that's going to be kind of a choppy sort of dynamic. Right. And so everything doesn't just go straight up and sits very stable as it has been, which is kind of interesting. But I tell people that the investor in me wants to lean in and get very long and be very invested. The trader in me kind of wants to take some chips off the table because we've run so much. So what I always tell investors is, you need to make sure your manager understands that dynamic and is managing that sort of cash and risk for you. But if they're not doing that, if you feel uncomfortable about that, then I would save a little bit of dry powder, because you're going to see some sort of volatility in here. That being said, I think it's really a good time to be involved in the asset class in general. And whether you pick a good beta product like our ETF, or whether you're in an alpha manager who really understands that risk, I think it's going to be a very important decision for you.
Absolutely. Mark, always great to get some of your insights here from the NASDAQ market site in Times Square. Thanks for being here.
Great. Thanks for having me.
Absolutely. And thank you all for watching. Stay tuned for more coming from the NASDAQ market site.